I'll show you how to trade crypto on Blofin. Today we're going to be trading in the futures market, so a little bit more active trading. I'll explain what futures are and exactly how to trade them. If you're looking for a beginner's guide for Blofin, how to get money in and out of the platform, how to set yourself up and trade in the spot market, I'll leave that for a video linked down in the description. You can watch that and you can see exactly how to set up on the platform. But what we need actually to trade crypto on Blofin is USDT in our account. In the futures market, all of the assets are traded against USDT. So we need this US dollar stablecoin in our account. You can see I've deposited some funds into my account here. Now, once you've done that, you can go to available here, this button. You can transfer in, because when you deposit USDT into your Blofin account, it goes into your funding account here. You want to switch that over to your futures account, press confirm, and then you can go ahead and trade. If you don't know how to do that, again, I'll leave that for the video linked in the description. It shows you how to get crypto and money in and out of Blofin. Now, if you want to on-ramp your money into crypto, that's probably best for some other exchanges like Kraken or Crypto.com. Again, I'll leave videos exactly on how to do that down in the description. And all the links to the exchanges I use, you can get deposit and trading bonuses on them if you're a new user, including Blofin. You can see as of right now, they're doing a deposit bonus. So whatever you deposit, they'll give you some bonus to go ahead and trade with. That changes over time. They have short-term offers that they change. So you can click the link below. You can see what the offer is at the time that you're watching this video. I'll be trading Bitcoin futures in this video. So exactly what are futures and how are they different to spot trading? Spot trading is where you cash settle your trades. That is your property. So if you buy Bitcoin on Blofin, you can withdraw it from the platform. That's your property and your Bitcoin. You can withdraw it to a wallet that you have, and you cash settle the asset when you trade it. In futures, it's completely different. We are just trading the price of the underlying assets. This is actually not trading crypto assets itself. This is trading a synthetic contract. It's a contract between the buyer and the seller to exchange the balance of trade between a buy and a sell. Right, so what we're actually doing is just trading the price of the asset and not actually buying and selling the underlying asset itself. Now you can see here BTC USDT. So the price that we're trading should match the underlying asset pair of these two assets. But all we're doing is trading the price and not the underlying assets. So if we buy and go long, that means that we hopefully benefit from the price going up. And we don't own the asset. We can't withdraw it from the platform. The only way that we can get out of that trade is selling, right? So that we actually get our cash back, but we made the profit from the buy and the sell. Now, because we don't actually own the assets, that means we can take short positions as well, which is benefiting from the price going down. Because we don't own the assets, we're not trading the assets, we're just trading the price. So you can go short without owning the asset, you can sell the asset or sell the price, and then if the price comes down, you actually buy back lower, right? So you buy low, sell high, either buying first and selling higher, or selling high and buying low. Now, of course, if the price moves against you, you start making losses, right? And so you have to fund those losses, which is why we put USDT on our account. The way that we fund futures trades is simply funding the potential loss. So if you have $1,000 in your account and you trade, right, you can trade and make losses up to that $1,000. And then if you make a loss of $1,000, Blofin will liquidate your trade, meaning essentially getting out of your trade and paying the losses so that you don't go into bad debts. So when we're trading futures, all our cash is for is to pay for potential losses. And that also enables us to trade with leverage, which means that we can open a position size bigger than the amount of cash that we have on hand. The reason being is it doesn't matter what the size of our position is, it just matters that we can pay for potential losses in that trade. So if I have $1,000 of USDT cash in my account, I can open a 10x leverage trade, which means I can open $10,000 trade. The reason being is I can pay for a 10% loss in that trade, right? If I open a $10,000 position, I've got $1,000 to pay for a loss. That $10,000 position goes down 10%, that's that $1,000 out, and I pay for that loss and I don't have any money left. But I can open that trade size because I can afford to pay for the loss. That then gets into using leverage intelligently and not getting completely wrecked, which of course we'll go through. But that's the difference with futures. It's for short-term active trading, and you pay for potential losses with your collateral, and you can take leverage with the size of your trade. Firstly, I'll go over all of these specifics that you need to know when actually entering trades, how to manage your leverage and manipulate the settings, and then I'll go over some strategies that I'd use if I'm trading futures. So the first thing you need to look at is hedge mode. So if you go to your settings in the top right, then you can see up here it says position mode, one-way mode, or hedge mode. This just means when you're taking an order, what will the trading system let you do? So one-way mode only lets you trade one way per trade. So let's say I've got a Bitcoin USDT position and I'm long. and then I want to take a short position. I can't take a long position and a short position at the same time if I'm in one-way mode. What I have to do is close the long position and then take a short position after that. So you can't have multiple ways, long and short, as different trades together. That's one-way mode. Hedge mode is when you can take a long position for 1 Bitcoin, and then you can take a short position for half a Bitcoin. So you're net long half a Bitcoin, right? Because you're long one and short half. So you're net long half, right? So that's 2 different trades. You can do that with hedge mode. I just put hedge mode on. It's going to let you take a long and a short, which you may want to do. Once you've chosen this and open a trade, you can't change it. So hedge mode is probably going to be the best because you can open a long and a short, and they can conflict with each other. It doesn't really matter, right? So press confirm here, and then we're in hedge mode. Another important aspect we have to choose before trading is what type of margin mode that we're using. You can see up here, we can choose between cross margin and isolated margin. Now, this is also important to think about in the aspect of account equity, which you can see just above my head where it says equity here under assets. So if we think about the account, you have an amount of cash there. So let's say I've got $1,000 of USDT. That cash is used to margin my positions, right? That $1,000 is essentially saying, I'm going to take some trades, and as long as I'm not making a loss up to that $1,000, those trades are going to run, right? So I have $1,000 of cash, and let's say I make a couple of trades and I'm losing $500. I've now got $500 of cash, right? So $500 of cash in my account. Now that's fine because you're not going to get liquidated and those trades will run. If those trades move down and you make a $1,000 loss, Blofin's going to liquidate those positions, get out of the positions, and you have to pay for those losses, right? So the margin mode and equity is important because if I press isolated again, when we use cross margin, that means that that USDT is being used to margin all of our trading positions at the same time. So I've got that $1,000 there, and I can open up a Bitcoin trade, an Ethereum trade, a Solana trade, and so on. Now, that $1,000 is used as margin to fund those trades. Now, as long as those trades are in a profit, there's no issues. However, because that same USDT is margining all positions, that's all I've got to keep those trades running. And so if one of the trades moves into a loss and it wipes out the $1,000, potentially all of those trades will get liquidated at the same time because you have no cash left, right? So that one position contaminated your other trades. And so that $1,000 would be used and all of your trades would be liquidated and would come out. Now with isolated margin, what you do is you isolate each individual trading position. So let's say I've got a Bitcoin trade that's in profit and I've got an Ethereum trade. The Ethereum trade loses money and it just gets wiped out by itself. You isolate the margin for that position itself, and so that wipes itself out and it's gone, but your Bitcoin trade is fine. The downside of this is that essentially you can't use trades to balance each other out because with an isolated position, you just make profits or losses in that position and that's it. So that doesn't contaminate your other positions. So for beginners, it's maybe a little bit easier because you just have each individual trade and you can see if you make a win or a loss in that trade. However, it doesn't give you the flexibility of offsetting losses with profits in other positions. So with cross margin, let's say I've got $1,000 in cash, one of the positions goes south. Well, if the other positions are in profit now, my account has account equity. Because I'm making profit in those positions, my account is in equity. So when you come down here, you should see the amount of equity that you have. Now it's just showing my cash position. But if I had trading positions and I was making profits in some, my account equity would go up because mark to market, I am in a profit, right? So if I sold that position immediately, I am in a profit there and I have value there to sell. And so with cross margin, if one position goes south, and you actually want to keep it running, then the other positions, if they're in a profit, can actually start to benefit you and not get liquidated on that trade. So it depends. For more advanced traders, they may use cross. If you're just beginning, each individual position, margining that individually so you don't contaminate other trades may be the better option. I'll choose cross here just for this example. Now I'll show you how to choose your leverage and what leverage actually is. So you can see up here where it says 10x. This is the amount of leverage that we're taking in our trade. What does that actually mean? If we press 10x here, you can change the amount of leverage that you use. Leverage is the amount of the trade size in relation to how much cash you have down to fund it. So cash is known as margin, right? So we need a certain amount of cash to fund the trade and lock that cash up in the trade initially when we open the position. Of that cash that we put in, how big is the trade size, right? So if I put $100 of cash in, and I use 10x leverage, that means the trade size is 10x more than my cash. $100 in times 10 is a $1,000 trade. If I have that same $1,000 trade and I use 2x leverage, that means that my cash is half of my trade size, right? Because $500 times 2x leverage is that $1,000 trade. So the amount of leverage that you use simply relates to how big is your trade size versus how much cash do you have down to fund that position. So let's use 2x leverage here. I'll press confirm. Now, what does 2x leverage mean? It means that my trade size is 2x my cash. So this is the trade size here. I've chosen the amount in USDT to show you, but you can choose an amount in USDT or BTC. I think USDT is easier. So $100 USDT with 2x leverage, that means that the trade size of 100 that I can trade with the market is 2x my cash. And you can see the cost to me is $50, right? $48. So $50 in, 2x leverage is a $100 trade. This is the trade size with the market. This is how much it is going to cost you tying up cash in the order. If I put another 0 on, it's exactly the same, right? 2x leverage. A $1,000 trade with 2x leverage means that I need to tie up $500, 500 times 2. If we change the amount of leverage now, notice that the trade size doesn't change, and that's because we choose that. So if we go to, let's say, 10x leverage, like this, press confirm. Now what you'll see is my trade size is the same because I'm choosing to trade with $100 in the market. So if I go ahead with that trade, I'll trade actually $100 size. Down here, the cost is $10. I'm using 10x leverage, $100 trade, 10x10, $100, right? This is the cost to me. So that's my cost. With leverage on top is the trade size. The reason leverage and getting leverage right is important is because it affects your profit and loss and the volatility that you can handle in the order, right? So with leverage, let's say I take a $100 trade and I use 2x leverage here. I have $50 in the trade to pay for potential losses. That means that if I get into a long trade right here, my trade can withstand a 50% drawdown because I have $50 in the trade to pay for potential losses. So if I have a $100 trade and it loses 48%, it loses $48. Well, I'm going to get stopped out at around $50, right? So I can withdraw much more, I can withstand much more volatility in the trade with low amounts of leverage. Of course, if you buy a cash, 1x leverage, you can withstand basically 100% downside move, right? Because you can fund the whole entire loss. Now, if you're using higher amounts of leverage, so let's say I use 10x leverage now, I only have $10 in that trade now to pay for potential losses. That means I can only withstand this amount of loss before getting liquidated, right? So I only have $10 to pay for that potential loss, which means my threat of liquidation is much higher, right? I can withstand much lower volatility. I can only withstand a 10% drawdown and then I'll get wiped out. So this is important when it comes to your trades, figuring out how much volatility in the trade that you can handle and want, and some technical analysis where you're saying to yourself, what is the expected drawdown from this price, right? What is the normal volatility that I should handle and be able to handle? Because if you say to yourself, well, this price could easily drop 20% from here, right? Then you can't use 10x leverage because you're going to get wiped out up here. So you don't want to get wiped out using too much leverage, right? Before you actually take a loss yourself from using a stop loss or just saying, hey, that really went against me and I made a loss, right? So the amount of leverage that you use doesn't necessarily have to increase the risk of your trade. If you know that you can handle, let's say, a 30% loss, then you can use 2 to 3x leverage without increasing the risk in your trade. You just know that you can withstand that loss and pay for it. So you have to work out where your entry price is first, and then where you potentially would get out of the trade because you think that the trade's moved against you and you don't want to take further losses. Wherever that is, if that's a 10% or 15% loss, right? So that's a 12% loss. Maybe I can use 8x leverage, right? And I just put less cash down in the trade, then I can use the cash elsewhere, right? I can put it into a lending protocol and get some yield on it, or I can just have it for different trades or anything else. So leverage can be used intelligently like that. But if you're just leveraging up 10, 20, 30x, you're going to get stopped out on a couple of percent moves to the downside and all your money's gone. So I definitely wouldn't recommend that, right? With such a volatile asset class, like 1 to 3x leverage, right, is is more than enough. Now I'll show you a simple strategy that I've used recently with trading futures, which is dip buying, which is essentially waiting for a drawdown in the price of Bitcoin to buy some Bitcoin, and then being able to withstand the volatility in that drawdown and waiting for the price to move back up into its uptrend. Now we're in a bull market right now, and I think this works for bull markets. How do you know if we're in a bull market versus a bear market? That's way too much for this video. What I'll do is link the crypto course down below. There's 300 videos here on analyzing crypto and the macro economy, but then there's private Discord groups as well where you can ask me questions about that. We update it all the time. So you can see on-chain analysis, we have trading videos here, technical analysis videos, we have futures and options trading videos. It's a whole entire course here, so much more in depth. You can see I update it regularly, and I update it for free forever for existing users. I'll leave the link below. That gives you much more in-depth insight into how the markets are actually moving. But if we assume we're in a bull market, and so what happens in bull markets, Bitcoin tends to have an expansion phase and then a drawdown from that as sellers come in. And then once you've exhausted those sellers, it tends to move back up again in its uptrend. So for me, I think that if you're buying a dip or buying a drawdown, you get a better risk reward for your trade, right? Because if you're buying a dip here, you can get in, for a decent amount of trade. But if you're already drawing down, right? So let's say from the high price here, we came down 25%. Well, from that 25% drawdown, right, the odds of it drawing down another 25 or 30%, get lower and lower, right? If you're in a bull market, there are only certain amounts of drawdowns that we can see in bull markets, right? So if you're in at that price, as long as you can withstand a certain amount of volatility to the downside still, then you should be able to come out the other side at a decent price and then start to make money when the price moves up again. How do we actually chart those drawdowns? We can see them all here. So during a typical bull market, which is all of them tracked here, the price of Bitcoin tends to move down 20, 25, 30% in a drawdown. And that's a typical drawdown. Now you do get a few that are much more than that. And so if you're in those trades, you may get wiped out for sure, but you can't win every single trade, right? Day trading or futures trading is higher risk, right? And so you're going to have to withstand that. But if you're trading all of these drawdowns and you're in at 25% drawdown, as long as you can withstand another 20, 30% to the downside, you should be good for another bounce to the upside again. So you can see in this bull market, we've had regular 15 to 25% drawdowns. If you're getting in at any point here, then you can wait for that next bounce. But also it's not just the bounce, because with using leverage and trading futures, it's about the liquidation price, right? So how much volatility can you handle to the downside? So if I'm getting in at, let's say, a 20% discount, something like that, yes, it's going to move a little bit lower, but from there, from that 20% discount, it only moves 15% lower. So I can take a bit of leverage and I'm fine. In fact, I take very low leverage. So with, let's say, 2x leverage, you can withstand a 50% drawdown from your entry, right? So you can withstand a 50% drawdown here, which is to the 40s. Is it going to get to the 40s? Highly unlikely for me, right? So it's all about risk reward and just getting into a price where you think, what is the likelihood of the volatility here? So if I'm getting in at 20% drawdown with 2x leverage, I can handle a ton of volatility. That's fine for me. And I can even buy more, a little bit more if it dips lower below my entry. So I can get a few entries during a dip, right? So if it's drawn down 10, 12, 18%, maybe I want to start getting in. I'll buy some. If it goes down again, I'll buy a little bit more, until my entry is pretty decent here at this price. Like this, maybe it's this price here that you got in at, and then you can obviously wait for that price to move back up again and start making money. So really, it's just about, for me, waiting for a drawdown, a decent drawdown, where I know that it's already down 20%. So the odds of it going down another 20, 30, 40% from there actually get lower because we're in an uptrend, right? And there's only a certain amount of volatility to the downside. Now, of course, you're going to get wrecked on some occasions when something crazy happens, or you go into a bear market and it just does actually go down 50% or so. And so, you're probably going to get wiped out on that trade, but we can't win every single trade when day trading or trading in futures. So for me, just getting a decent entry is the good thing in a bull market, and knowing that as long as I actually win most of those trades in general, then I'll make some profits in my portfolio. So from here, what we want to do is find an entry price like this, make sure that we're not using too much leverage so we can handle a ton of volatility in between, and then just wait for the uptrend to continue. I'll show you how to enter trades with that strategy then. So if you are waiting for a dip at some point, if it's 20, 25% down or something like that, you may want to start entering into a position. As of right now, we're actually just breaking out. So let's take a long trade at this price. And let's say that for me, I'm happy with a kind of 30 or 40% drawdown, right? That's the volatility that I want to allow. So for me, I know I can't use 3x leverage, right? Because it's going to wipe me out at 30% loss. I want to allow for a 40% loss. So for me, I'm going to use 2x leverage and just give the trade a lot of volatility and room to breathe. So We're going to enter a market order here because I want to get the trade open. So we're going to trade at this price. So we're going to trade a $100 trade with 2x leverage, which means I have to fund 50% of the position, $50. And we can also put our stop loss in at the same time. A stop loss is where you actually get out of the trade at a loss. So if I'm in at 107 and I want to take, let's say, a 40% loss, that would be, let's say, 60,000. So I could put my stop loss in at 60,000 and I would actually sell out myself at a loss at 60,000 if it got there. And that would just prevent me getting liquidated. There's no terrible thing about getting liquidated, right? It's just, you just sell out of the position and you pay slightly higher liquidation fees, I believe, which, you know, if you're making a loss anyway, maybe it's not relevant. So with 2x leverage, you know, a stop loss down here, I mean, you can put it in if you want. It doesn't really matter. Either get liquidated at kind of 58 or sell out at 60. But this is basically a trade that gets you out of a position at a loss. So I'll put my 60,000 in there, and my take profit I won't put in for now. But these are other orders entered at the same time that you enter your long trade. You don't have to, you can enter them after you traded as well. So let's just put the stop loss in. So we'll go long, shows you everything, press confirm, and then you've got that trade open. So you can see I'm long BTC at this price. You can see the red line here is my stop loss. What I can do is drag this around if I want to trade it. So that actually changes the order. Because remember, we've bought, so we've gone long, and that is essentially a sell order to sell out a loss that wipes out your trade, right? And so we can change that around, but you can see my total price for the trade, the average price that I got in at, the amount of margin that I have in the position, my running P&L. So the P&L right here is the profit or loss in the trade that it exists at. The realized P&L is if I actually sell out some of the trade. So I can maybe sell out half of this trade and make concrete a profit or a loss, and that's your realized P&L. And you can see the mark price of the futures contract right here. It's going to be about the same price as the market traded price right here. Now you can close all if you want, or you can close an amount. So an amount here is, let's say I want to choose 50% of the order to trade out. I can do that, press close, and that wipes out a little bit of the order and it makes my order smaller. What I'm going to do though is press close all, confirm that, and that cancels out of the trade and all of your trades are out. So that's how you would open the position. And of course you want to let it run. You can have your stop loss in there if you want, but otherwise you can just let the trade get liquidated if you are trading with an amount that you're happy to get liquidated. Because with futures and day trading, this is more risky, so this is money that we can afford to lose and obviously get the trade wrong. Now I'll show you a sample short trade, which is where you sell first and then you aim to buy back lower. So it's exactly the same thing. Cross margin, 2x leverage. I'm going to open the trade. Opening the trade is what we want. We don't want to close the trade. Closing the trade is, if you have a long trade, you want to close it by going short. You can see close long here. If you have a short trade, you want to close it by going long. And that equals out the trade to obviously having no position. We want to open a short trade though. So open $100 trade size with 2x leverage means $50 cost. And let's put a stop loss in. Now the stop loss is going to be higher because I'm selling first. So if I'm selling at 107, I want to take a loss maybe at 110. Now I don't personally short. I don't trade short ever because, well, Bitcoin is a growing asset class. It's going up, right? It's the best performing asset over the last 16 years, right? So why would you go short that, right? You want to go long. But in any case, if you do want to short, if you think we're in a bear market or something, you can open a short trade. Trigger, the SL trigger is 110,000, so that's where I'd be taking losses. Short, press confirm. You can see we've got a short trade here. Bitcoin, short 2x. Total trade size, you can see my running P&L, and then we can close that as well. So you can see right here, the red is my sell order, and the green is the stop loss, which is buying back the asset at a higher price, which means we'd be taking a loss because we sold low and bought high, which is not the right way around, right? So you can see all the trade details here, and we want to close this, so close all. You can also go up here and close it by closing the short, so $100 or whatever it is, you can close the short. However, it's better down here because then you can get the closing absolutely perfect. So close the order, close all, that closes everything out, and no trades in. I'll leave the deposit and trading bonus links to Blofin and the other exchanges I use down below, and the crypto investor course link down there if you want way more in-depth trading guides and information about the markets. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.